Yo, what's going on, fellas? Gonna do a mic check. Looks like audio is good. We've got audio coming out of here. What's going on, fellas? It's your boy Daily Crypto, and we got a special presentation for you today. We're gonna be looking at trend lines. I'm gonna show you guys how to draw valid trend lines. This is something quite a bit of traders struggle with. It's a little bit different from horizontal support and resistance in a couple aspects, but it's very similar in many of the aspects. So we're going to talk about that today. I just want to give a shout out to TCal. He's one of our supporters in the lobby. Lucas M, first one to drop a comment today. What's up, Lucas? What's up, TCal? And we got Ricky Spanish in the house. Says to the moon. Ricky's going to be our what do you call cutaway guys? Like, have you guys ever seen the Joe Rogan Experience? He's like our Jamie. So we're gonna go ahead and introduce Ricky Spanish as our whatever the fuck you call that backstage operator type guy. So shout out Ricky Spanish for being the backstage operator type guy. Ricky, why don't you take us over to the chart and put me in the middle? Yeah, that's perfect, Ricky. Thank you so much. All right, actually, you know what? Can you throw me in the corner, dude? Yeah, just like that. Perfect. All right, fellas. So today we're going to be talking about drawing valid trend lines. If you have any questions at any point in time, just go ahead and drop it in the comments, and I'll be looking at the comments periodically to answer your questions. So if you have a question, I don't want you to sit there and think about it until I'm done talking, and then you don't listen to what I'm saying. So just go ahead. Whenever you have a question, type it in the comments, and I'll answer it. As soon as we'll take some breaks, explain to you guys what's going on, and I'll ask you guys directly if you have any questions. So I'm going to be reading from, got a little teleprompter here. We're trying to step up our game. So I got a little teleprompter here. If I'm not making direct eye contact with you the whole time, it's because I'm reading off of my teleprompter. So, guys, many traders are familiar with horizontal support and resistance zones, which is where you draw a line on the chart at a place where price struggles to fail to break above or below. If you're not familiar with horizontal support or resistance, we can do another session about that in the future. I've definitely covered it in some of my live lessons and video tutorials that are on my channel. But essentially, a trend line is going to be a dynamic support or resistance zone. So dynamic simply means that it's going to be moving with the trend. So it's not a stagnant level. It's not flat where price has to keep coming back. I can actually show you a little bit more about what horizontal support and resistance is when we talk about consolidation. So we are going to talk about the three market phases today. Now, when we talk about consolidation, some people will break that into two phases. Some people say there is accumulation phase and a distribution phase in the consolidation, and they're not wrong. Technically, there is an accumulation and a distribution, and they both show up in the form of consolidations. But the technical market phase is called a consolidation. There's only going to be three market phases. We either have an uptrend, we have a downtrend, or we have a consolidation. Okay? So trend lines are useful in helping you determine the trend as well as the strength of the trend. If you follow the trend, then half the battle was already won. If you've ever seen any of my content anywhere before, you probably know that I say the trend is your friend. If you trade with the trend, you have a higher chance of being successful rather than trading against the trend. Now, you could still trade against the trend. It's not what I recommend for a novice trader or someone who is brand new to the crypto market or trading in general. So once you can identify a trend, do yourself a favor and trade with the trend. It'll help you be more successful, at least when you're getting started. As you develop, you can start to identify counter trend signals and maybe take counter trend trades and be successful. But we're going to leave that for a later stage. When you're just getting started off, let's try and identify the trend and trade with it, okay? So first thing we're going to talk about is an uptrend. When we are in an uptrend, price has a higher probability to continue creating new highs, meaning that when we are in an uptrend, price has a higher probability of moving up, right? That's pretty self-explanatory. So an uptrend is defined by higher highs and higher lows. In an uptrend, you must buy the dip, never buy the high. We always want to go long on an uptrend when the price dips or pulls back. We never want to buy at swing highs because we know that eventually the price must dip before continuing to move higher if it is going to move higher. So here on my screen, Jamie has put us up, or put me in the corner here, and Jamie, excuse me, Ricky has put me in the corner here, and we have an uptrend right here, okay? So I'm going to back this up for a second. When we have 2 points, oh, I'm sorry, I accidentally reversed there. Let me go ahead and, where has it, replay, okay. So I'm going to go ahead and back up to right here. So once we see this forming, we know that we have a higher low. This is a low point in price action. This is a low point in price action. So there's a little bit of microstructure here. And yes, if you want to be technical, we can call this, a downtrend. It could be associated on the top and the bottom. We'll look at downtrends in just a second. And that is microstructure. You could break this down on any time frame and identify structures and trends within larger structures and trends. But just for the sake of observing and learning, we're going to take note here. This is a low point in price action, and this is a low point in price action, right? So price has come here, created this low, came up, created a higher low, came up, and then created a lower low. Price came up, created a higher low than this one, and now price has formed a higher low. So when we are looking to identify an uptrend, we're trying to connect low points. We can draw back, we can go back in here any point in time to try and find our trends by just looking at the low points and see, okay, these low points are rising. Here is an uptrend. When this uptrend is broken, you can expect a reversal or consolidation. And we can do this time and time again. We'll just go back and we'll just see, okay, here's a low point, here's a low point. This low point is higher than the previous. That is a projection, right? We don't have 3 touches on it. 3 touches are going to make a valid trend line. So I just wanted to show you how to find an uptrend, and let me just go ahead and go back to where we are now in the replay. So once I have 2 points, I can make a projection. This does not mean it's a valid trend line. The 3rd touch could fail, right? So if we just play this forward a little bit, oops, I just go ahead and exit now. I see the play bar right there, but I'll just go ahead and, why is it playing so slow? 1x. Okay, let me just speed that up a little bit. Okay, we'll go to 10x because I ain't got time for all that. So we see price is coming up, and now right here, it has also formed a higher high, right? Because price broke this level. Price broke this level right here. So we can see this was a high point right here. This was a high point. Price is breaking above it. So now if we change the slope of this line, we could see it's going up, right? So this is a higher high indicative of an uptrend continuation. So if we just let this play out, we see it forms another higher high, and boom, we get to here, okay? So here is the 3rd touch. When you have 3 touches on a trend line, you can consider it valid and start to speculate on it in the future, right? Because you know that there is a likelihood for prices, for people to buy right here, right? An uptrend is defined by higher highs and higher lows. So in general, you want to go long on the uptrend when the price dips. When you see an uptrend here and you see it breaking a new high, you don't immediately want to shoot in for that. There are a couple different things that can be happening in the market which may prompt you to say, hey, you know what? I am going to shoot in right here. But generally, we want to wait for some type of pullback because we know that price has a likelihood of coming back to this level at some point in the near future. Okay? That's exactly what we want to be looking out for whenever we are considering this, right? So let me see if I can just move to the end of this. We have our 3rd touch, and it looks like here we are. So if I could just go ahead and get out of the replay. Do I want to exit the replay? Yes. So right here, this is a good buying opportunity. The likelihood that price breaks below here is not as great because we have a valid trend line. And if it does break below here, we have a very fine point to where we could put our stop loss. So just for example, if we wanted to take a long here, we would try to buy in on one of these ranges here when price comes to the low of this trend line. And we'll place our entry somewhere around here with our stop loss either just below the trend line if we're going to be conservative, or just below the recent swing low if we want to be a little bit more safe and secure. Then we can target that swing low, because price could do something where it falls below here for a brief moment, and we see a wick here, maybe even a candlestick close below, and then the next candlestick pops up above. So it's possible we could see something like this, and as long as it doesn't break this low right here, we can consider this pull back out of the range and valid for a long-term continuation. So this is about where you're going to want to place your stop loss. Like I said, your entry is going to want to be as close to this trend line as possible. That way you can get the best entry. The further away your entry is from this trend line, the less ideal it is. And we can take note of this swing low, we can take note of that swing low, depending upon what the percent is. Here it's only a 0.93% stop loss, so that's not terrible. You know, depending upon what your risk reward ratio is, you could drag this down to another swing low. So that way it could avoid you from getting stopped out in some of those areas. Now, we've taken a quick look at what an uptrend looks like, and we're going to go a little bit more into depth too with uptrend channels, and I'm going to show you guys how to really set up your layouts whenever you're trying to chart these things to find entries and exits. So now we got to talk about a downtrend. So here I've got a couple other small things right here. This is a consolidation we're going to talk about. But here we have an obvious downtrend, right? So we see this is Bitcoin on the daily time frame. We can see here there was a high point. Here's a high point, but that high point is lower. So on a downtrend, there's a higher probability that prices are going to move lower. A downtrend is defined by a series of lower highs and lower lows. In a downtrend, you need to short sell the rally. Never short sell whenever it's at the bottom, because that, you know, when price is at the bottom of a channel, you know it has a likelihood to rally up before continuing its descent. So here we see this was a large scale downtrend and a very clean one that I wanted to show you guys, because remember how we talked about two touches having being a projection. So some people can count this as one touch, two touch. There are a couple different wicks here. If you look at this on the weekly or the monthly, you might count this as one candlestick. There are a couple different touches here. So whenever we got up to this point, it was pretty obvious that there would be some rejection. Now, whenever we ultimately break over a downtrend line, it's indicative that prices could reverse, right? But here we see that price played off of that very well, and we're at that resistance point again. So it's very important to take note of where you are placing your shorts on a downtrend. So ideally, whenever we are looking at a downtrend and we're looking to take a short position, we want to get that short position as close to the trend line as possible. Our entry, we want to make our entry as close to the trend line as possible. We don't really want to wait for that big old candle to close, because look, you know, how it could upset your risk to reward ratio. Remember, if your stop loss is just over the trend line, having an entry far away from that trend line can really upset your risk to reward ratio. See, if we were entering here, somewhere about, because we had identified this range where we wanted to take a short, we had this information available, and we say, you know what, next time price ranges into this area, we're going to take a short. So trying to get your entry as close to that trend line as possible is fantastic. That's what you want to look for. And then again, we're going to try and put our stop loss just over that trend line. Or if we want to try and, you know, target a previous swing high, so this would be a swing high, then we'll just draw that line over like this. Let me move it right onto the wick. And then we're going to want to try and extend our stop loss beyond that. Now here in this example, we have a 14% stop loss. Some people might not be comfortable with that. Some people might take this position and just lower the amount of funds that they were going to put in the trade. But this is what you're going to have to decide for yourself based upon what current market structure is available to you. Now, in this particular situation, shorting from here was pretty easy money because this was a major trend line. It was on the daily time frame. So something about trend lines, the larger the time frame, the more validity it has. If you're trading on the 1 minute, 5 minute time frame and you see a downtrend or an uptrend, that hasn't been occurring for a long time. And it's not going to continue for a long time because it's on a smaller time frame. And it's eventually going to break out of those micro structures that we were talking of earlier and ultimately play into the larger structure. So let me just put that into perspective for you here. Here we have what can be considered an uptrend. But if you were looking at the bigger market structure, you could see that this was a bear flag, right? So here we see a bear flag. Price is forming higher highs. Price is forming higher lows. So that's an uptrend. But it's an uptrend inside of a downtrend. And remember, we can break this down into many different time frames to identify this. So we knew that from this uptrend, the range of price ascending would more than likely meet conflict at this area. And it actually broke down before we got there. And when it did get there, ultimately, there was a reaction. So that's just an example of how we can see, you know, a different trends and different structures within each other. So that is how we're going to want to try and take a look or take advantage of a downtrend. Let me go ahead and delete that now. And we'll come over to show you what a consolidation looks like. So I've got one right here for us. And this is the same chart we were just looking at. I just have it zoomed in a little bit for that consolidation area. So here we can see consolidation, consolidation. So this is what would be referred to as horizontal support or resistance. Whenever prices move sideways between a support zone and a resistance zone, support zone, and that's a nice little line right there. We can make this a zone because there are not a bunch of fine price touches along this line. So we can make this a zone on the top and the bottom. It doesn't have to be a fine line. If you can get a fine line out of equation or out of a market structure, then it's going to give a lot more validity. But here we could see that price is trading below a support, or I'm sorry, on top of a support zone and below a resistance zone. So support and resistance represent key price levels where the forces of supply and demand meet. Eventually, price breaks out of the consolidation, but we never really know until it does. So something like this, when you have a consolidation and you're waiting for the breakout, you can trade the breakout as soon as you see it, right? And what could be considered a fake out, like here in this scenario, where price breaks out towards the downside but actually comes back. Now, there is a profitable move here. If you see there's this big red candle breaking down out of that consolidation, if you were to jump on it immediately, you will see that there is some room for profitability. In this particular instance, it's up to 5%. So here we see that Bitcoin's kind of consolidating again. Right now, this is actually where we are in the current market price. So Bitcoin's kind of consolidating right now. I prefer to trade with the trend than to trade in consolidation ranges, but I just want to give you an idea of the 3 market phases for you to be able to understand market conditions when you're doing your technical analysis. When you're looking to make a trade in any currency pair, first you need to identify if the currency pair is in a downtrend, an uptrend, or a consolidation. You don't want to take a long position in a downtrend. You don't want to take a short position in an uptrend. Now, like I said, once you progress a little bit, understand more about trading and identify signals, then you can possibly start to counter trend trade. I do it sometimes. It's not what I advise novice traders to do or entry-level beginner traders to do. It's going to confuse you, and you're going to be taking way more of a risk than you're prepared for. So let's just go ahead and try to trade with the trend because the trend is our friend. So now we're going to take a look at market cycles. So a market cycle is a combination of all 3 market phases. First, a market consolidates, and this is like that deal, which came first, the chicken or the egg. You can't really tell what is first. Is the consolidation first, or the downtrend, or the uptrend? There's no specific order in which they're going to occur. But just for the sake of learning, we're just going to go ahead and put it this way. So let's just say a market consolidates. Then the market breaks either into an uptrend or a downtrend. And during the breakout is the best time to go long or short. Once the trend has been identified, after an uptrend or downtrend is exhausted, there's usually a reversal. It could go from exhausted trend, it could go from consolidation to breakout. Let's say it breaks up and then go back into consolidation. It doesn't always go consolidation, breakout, reversal. And in just the same way for going down. It doesn't mean consolidation, breakdown, and then immediate up reversal. But when you have a consolidation and a breakout, you know that move cannot continue forever and it will become exhausted at some point. So that is when you need to look out for the reversal or the consolidation, right? So this is a market cycle. So I'm going to show you a couple different pictures I got here that we have pulled from different market cycles. So here we can see this is a consolidation. It breaks into a downtrend, comes into an uptrend. Now here it looks like there's actually, remember I told you, it doesn't always have to be an immediate uptrend. There's a small consolidation here, and this is on the 1 hour time frame, so that would have been a consolidation. But overall, in general, here we see higher high, higher low, higher high, uptrend, okay? And here is that same picture with the consolidation written, the downtrend, and the uptrend written. Here we have another example. Consolidation goes into a downtrend, reverses into what is an uptrend. Here is another example. We have consolidation, breaks into a downtrend, turns into an uptrend. And we have one more example for you here. consolidation, downtrend, uptrend. So it doesn't always work like that. Remember, it does not always work like that. But even here, we can see in this recent example that I gave you, consolidation, downtrend, reversal, uptrend. Okay? The three market phases are all, there is one market phase always in existence, and you need to identify which one it is. So if we're in a consolidation, you can trade a consolidation. I'll show you how really quickly. But like I said earlier, I would not try to trade a consolidation unless I had some other technical observation available based off of an indicator, an EMA, or something like that. But right now, we're just looking at price action, talking about drawing valid trend lines. So to trade inside of a consolidation, we're going to go ahead and get our risk to reward ratio. If we want to go long from the bottom of a consolidation, it's going to be, the entry is going to be somewhere in our range. So here we have a high range on the wicks, a low range on the wicks. So we'd want to put our entry somewhere in here, in this area. And then our stop loss is going to be, well, just below that range. So if we extend this all the way to where it truly is, let me just draw that down here. Then we can see the wicks range right here. And if we put a stop loss below this, that means if price breaks out of this consolidation, it is likely that price will continue a downward descent, so we don't want to be involved in that position. And then we can try to target back to the top of the consolidation range, meaning we're going to wait for price to come here so we can get our entry and try to chase it up. On the flip side, if we're trying to take a short inside of a consolidation range, we want to identify where our wicks are. So let me just go ahead and delete this line, and I'll draw this down to that wick right there so we can touch that wick. And this is going to be, for right now, this is going to be the upper end of the consolidation. So if you want to take a short in this area, that would have been a good opportunity to take a short. You want to try and get the short entry in the top zone of your consolidation, and then put your stop loss right outside of it. And in this particular example, something that can really help us is we have a valid downtrend line. So we know that there's a probability of price rejecting from this short-term consolidation zone and this long-term resistance zone. So in this particular case, we can go ahead and put our stop loss above that downtrend line too. Meaning if price comes here, breaks up above this, and then continues above like this, we want to be out of the position, because that means price is more than likely reversing or breaking out of this consolidation and going to start traveling upwards. So trading a consolidation is risky because we don't know which way price is going to break out when it breaks out. We only know when the breakout occurs, okay? So trading a consolidation is a little bit harder because we don't know which way it's going to go. But remember, in an uptrend, we have an idea or a thesis that price is moving higher, creating higher highs and higher lows, so the probability price continues to move higher is greater. Same thing for a downtrend, but in the opposite direction, right? So we're going to take a little pause right here, and I'm going to see if you guys have any questions before we move on. And then I will show you guys a couple different examples of what we would call channels. So whenever you can find a channel, you have a much higher probability of being successful. But let me take a look and see what kind of questions we got. Rob Hawkins says, Coolio died last night. Damn, Rob, I don't know who Coolio is, but, you know, R.I.P. Coolio. I hope he's up there. I don't know if they got Bitcoin in heaven, but, you know what? I'm sure Coolio is having a good time. But he also says, yes. Hey, Niaz. Niaz is here. He says, hi, sir. Shout out Niaz. He's also one of our supporters. Got the cool green name and that badass tag next to it. Niaz says, how do I identify breakout? As sometimes BTC has dumps in matter of 1 or 2 minutes. You're very correct about that, Niaz. And the way to identify a breakout, like we're generalizing here, is you have to confirm when price breaks out. You can shoot the ship as soon as the breakout occurs, but once the breakout occurs, you want to make sure that the trend beforehand, like this one preceding it, here, this is going up, and this is going up. So while we have a consolidation in here, right, price is struggling to break below here, price is struggling to break above here, but in the interim, there's an uptrend. So one way to tell if an uptrend is going, or a breakout is going to be valid or not, is it continues the trend prior to the breakout, right? So if price came in here, did this number, breaks out, does a retest right here, and respects this, or even breaks above, that's indicative that price can continue upwards. So we're going to be looking at that micro structure. Remember, you have to pay attention to multiple time frames. Don't just dial into one time frame. We haven't talked about multiple time frame analysis today, but I do have tutorials about multiple time frame analysis, so you can go and review that and learn how to look at different time frames to complete your analysis. But that's something that you're going to look out for, Niaz. So remember, here this is a microstructure, but on the flip side too, if price comes here, gets rejected, breaks out, we know that microstructure is not valid, and then we need to start looking for potential downside action. Maybe it forms a channel to the downside like this, something of that nature, and then we start to track it the other direction, okay? So let me just go ahead and get rid of this. Thanks, Niaz, for asking the question. TKL had a question, but I already answered it. That's what's up. And remember, fellas, don't dwell on those questions. When you have a question, just type it in the comments. That way you're not stuck thinking about it, and you can listen to the presentation and consume information. All right, so something about a parallel channel gives you more validity when you are trading. So I've highlighted a couple examples in Ethereum. It's really, really hard to find a parallel channel in nature. But when you do find one, boy, can you trade that. And let me show you how. So whenever we have an uptrend here, we can see this is an uptrend. And this channel is not picture perfect. It's going to be extremely rare when you find a picture perfect channel, although they do exist. This is pretty close to a picture perfect channel. So we're identifying here, we got higher highs, higher lows. This is sloping upwards, and this was on the 4-hour time frame. This was a fucking phenomenal uptrend to trade, right? So whenever we get here, we're saying, all right, when price touches along the bottom, we're going to be looking for longs. So we don't want to counter trend trade. However, I will show you how to counter trend trade. But I want you to continue in your trading, not trading against the trend until you have multiple confirmations telling you to get in that position. Because when you're in a situation like this, price could break above here and create some kind of parabolic state. If price breaks above your uptrend channel, that means price is probably going to continue higher. So you don't really want to be shorting in these scenarios, but I'm going to show you how to set it up anyway, because I don't want to close you out of any information. So here, whenever we're looking for a long in a parallel channel, we want to try and place our entry as close to this as we can. So something that I like to do is I like to give myself a range where I know I'm going to be comfortable entering based upon wick structure or something of another nature. So I draw actually multiple lines within inside of it, and I'll show you another chart in just a moment where I do this as well. So here you can see my white dotted line, and I'll just go ahead and clone this, take it to the top, right? So we have this dotted line in the middle. This is our median range. This is where we're not afraid to take profits. We have this dotted line on the top. This is also an area of profit taking and an area for short entries. And on the long, or on the bottom, we have an area for long entries and profit taking area for short entries. So let me show you what I mean by this. This area is where, if I have deemed myself comfortable to enter, is my entry range. So I would be comfortable taking an entry in any one of these positions in this area, and I would draw that, measure it out, and say, oh, you know what, that's a 1.17% range, about 1.5%, So I could say, all right, I'm comfortable entering within this range, and then I'll put my stop loss. Remember, we can put it just below the trend line structure to be ultra conservative and ultra tight, meaning if price breaks below this, it's likely it's going to reverse direction or at least break out of the uptrend and consolidate. So we don't want to be involved in that position anymore. And then we can target up to the top of the channel, of our established channel. Now, sometimes whenever we get into these situations, price will stop at the median line or somewhere around there, and you have to be comfortable taking profits. So you don't have to just let this ride all the way till it hits your take profit goal or stop loss. Generally, we want to manage our trades, especially once they become profitable, and remove this stop loss that would have been a losing stop loss and implement the stop loss at a higher position by adjusting the price at which we are going to close the position. So this would become a new stop loss, right? And you'll move this up as price ascends, ultimately chasing your trade and trying to squeeze it between this top channel and your stop loss. So whenever it does break back below, You get stopped out for a profit if it didn't reach all the way to the top of the channel. So that's kind of how you want to take a long. And remember, if you want to be a little bit more, if you want to try and drag below a previous low, this would be the swing low where we would have to drag to if we wanted to practice off the swing low. But that's 15%. So I wouldn't take that. The channel here is a really nice channel, and I would just put the stop loss right below that, okay? Now, if we want to take a short in an uptrend, now remember, I'm advising you against this at first. I'm showing you how to set it up. So, just like we had our long range, whenever we want to take shorts, we're saying, okay, price is within this range, I'm comfortable getting in. I'll put my stop loss above the trend line or above a recent high. And in this case, it's a little bit easier because we're already there, right? So we can put it right there outside of the trend line, and it's above that swing high as well. But the risk here is if price does that moon shit, you get stopped out really quickly. So you have to be able to enter, in a comfortable position. And ideally, we want our entries for shorts to be as close to this trend line as possible. Same thing for longs, whenever we're looking for longs. I know we've identified this range where we're comfortable entering, but we really, really want to push our entry as close to this line as we can. Same thing for the top, because that's going to make our risk reward ratio better. Here we see if I leave that stop loss there, it's 1.5% stop loss. And if I move it down to the bottom of the range where I'm comfortable entering, yes, I said I was comfortable entering there, and I know what my actions are going to be if I get there. But look how it changes the risk to reward ratio. Right now it's a 2.5% stop loss. And if I'm targeting downside here, I want to try and target to this dotted line because I don't know that it's always going to go to the end. So here when we see this dotted line touch, we could set up multiple take profit targets. So we could have a TP1 here. We could have a take profit goal here, and then we can just go ahead, clone that, and set up another take profit goal at the bottom of the channel, okay? So if we wanted to say this, take profit 1 is at the bottom of this white line, take profit 2 is actually at the bottom of that trend line. So if price does this number where it touches and reverses back up, we get out here, right? The entire position is closed right there. And if you are a advanced trader, or you know what you're looking for and you got some practice underneath your belt, you've got some experience, once you close your short position, let me get rid of these take profit goals here. Once you close your short position here, you're in your range for entry on longs. So you can dub the fuck out of a channel, dude. Price channels, parallel channels are amazing because you can just do this shit back and forth until it's over with, okay? So it's like, hey, I'm breaking out of here. It's breaking up. Here, it's in this range. Taking profits. Okay, it's leaving that range now, and I can go ahead and get my short in here. So it's not always going to be picture perfect, but you can straight the fuck up trade against yourself like this. If you're closing your long, that means price is going to reverse more than likely within that microstructure, and you can take a short, okay? So you don't always want to try and pressure yourself that way. Just because you close one trade doesn't mean you have to open another. But generally speaking, if you're closing a trade, it's because you believe price is going to reverse in direction or consolidate. And if that is your true belief, why not take action against it? Now remember, I don't want you guys to do counter trend trades at the beginning because you can easily get fucked. You have to look for a lot of different things. You have to check out different market structure. You have to look at your indicators to see if taking a counter trend trade is actually worth it. But let me show you how it can be worth it. So let's just say, for example, you were counter trend trading here, and you took your entry here, and you got your stop loss a little bit above that trend line, so you don't get stopped out here, and you're trying to chase towards the bottom. Okay, great. Now, if price does something like this, where you get out here, there are a lot of different ways where you can set up like where you're going to be comfortable with your take profits. But here we see it comes up and breaks down. So this trade here could have actually turned into a mega winner. This could be a huge payout as we see price continues to go down. So the best benefit of counter trend trading is when that trend finally does break, you have the best position for the breakout. So let's just imagine you didn't set this position up, you didn't short from the top of that rally, and you see prices breaking down here. Well, now you have to look for a retest, or you just have to be aggressive and shoot the ship. And the way you would set up a short position here after the breakout is you have to identify, same thing, flip side, where your range is on the outside that you're going to be comfortable entering. Okay, now it's broken below. And you say, hey, you know what? I want to try and go ahead and short that. You'll have to set up your short entry here. And then you'll put your stop loss above this range. You can choose the recent swing high, but I would more notably put it along that range, because if price does this number where it comes up back in here and re-enters the channel, you don't want it to be so extensive to where you lose a lot of money. But that is how you would have to play this breakout if you didn't have this long or this short position from earlier. So counter trend trading, remember, it can be dangerous, it can be tricky, it can get you stopped out in a quick and in a hurry. But if you get that counter trend trade in the right spot, you have the best setup for the breakout. Here we see a 17% risk to reward ratio, or 17% profitability range, versus here, if we're just going off of that breakout and we're shooting the ship aggressively, even if we got at the end of the range there, which was the worst movement, it comes out to 11% profit. And that's not terrible. It's not terrible by any means, but look how much more money you could have gotten. And it's really, really nerve-wracking whenever you're here, whenever you are right, where's the replay? Whenever you are right here and you're seeing this big fat candle, and you're like, oh, price could shoot up really quick and invalidate me. So this is a lot riskier to get in. You have less confidence at this point. Yes, we see it breaking the structure, but until we actually have that, remember, confirmation. And now we're seeing, what are we seeing here? Lower highs. Right here, this is actually considered a wedge or a consolidation. So we're playing this trend line and this trend line. And when you see this one break, boom. So you would have to shoot, this is the 4-hour time frame. You would have, if you're using multiple time frame analysis, you could drop into a smaller time frame and try to find that preferred entry. But that is where things get a little bit tricky whenever the breakout actually does occur. Let me just go ahead and get out of the replay. And where are we at now? Okay, it took me way over here. All right. So we've taken a look at how to trade a parallel channel that is in an uptrend. Now, it's going to be the same thing for a parallel channel that's in a downtrend. Here we can see this channel didn't have as long, or it didn't go on for as long. It wasn't as tall, but it was still there. There was still, this were 2 points. So if there was a third point in the future touch, here there were 2 points, and this third point break below. So I don't have any downtrend channels ready to show us, but I do have a CRO downtrend formation that I want to talk about. So right here, from these 2 points, we have a projection. And from here, we have the third touch. From these 2 points, we have a projection. And from here, we have the third touch. So here, we can see this was the upper range and the lower range. This is where the lows are connecting. This is where the highs are connecting. And I've identified an interim range where I am comfortable taking shorts and comfortable taking longs. So whenever we see a falling wedge, if you've studied chart patterns, you know that price has a probability of breaking out of the falling wedge in an upwards fashion to some degree. It doesn't always mean it's going to break those resistance points where you can target all the way back up to where the formation started. But whenever you're watching for that breakout there, you know, hey, this is getting a tricky situation. And here, while I said in the previous example, you don't want to go against the trend. Whenever you have a structure like this is not a parallel channel. If it were a parallel channel, we're going to want to try and short from the top, long from the bottom. Here, it's the same thing. You can try to short from the top and long from the bottom, but in a falling wedge predicament, I would like to try to long from the bottom more than shorting from the top, because I know the likelihood of price breaking out of this bullish is going to be greater. So whenever we're setting up our long positions, they're usually around here towards the bottom. And then as price pinches down, we're going to have to squeeze that risk to reward ratio to fit into as the formation comes lower. But here, whenever it does break up, again, we see we have the best entry, right? This is a 24% move because we got in when we were comfortable down here entering our range. Even if we got in on that last one there, still we could have got up to 25%, right? Versus the guy who did not counter trend trade, because remember, is a downtrend, we want to short sell the rallies where it touches the top. But with our information that we have available to us, because we study and we learn and constantly consume information, constantly trying to better ourselves, we know that a falling wedge more often than not breaks up. So when this person is trading along from the bottom, like me, I would like to try to take those longs. It's a much better situation than when this person actually does get a pullback. So remember in that last downtrend trade, we didn't see a pullback. It was an aggressive move down. You would have had to jump into a smaller time frame to take advantage of it. Here we actually do have a two candlestick pullback. And let me just go ahead and delete that real quick. So we could see that if we put this below now, what was our interim range there? We can go ahead and target up. So if we have only seen this, if this is all we have seen, let me see if I can get one candlestick to come out. Oh, there we go. That one. Okay, so if this is all we have seen here, we know that we could place an entry on this candle and at least target to here. If it goes up above, we'll try and keep riding that, okay? Because here is the breakout, here is a retest. So you'll want to try and gamble on the retest with a stop loss below that point. Then we see it comes up, creates a new high. It breaks that high. Once it creates a new high, we're going to be skeptical because we know, hey, it's just created a new high. There's got to be a pullback at some point, right? And while this was a profitable move, even if we were using a retest, there's no doubt about it that the guy who took the long from here got a much better entry, right? And he was able to ride it up dynamically. Maybe he used EMAs as well to give himself a benefit, or a, what do you call that damn thing? An advantage. And then we're just going to put a short-term uptrend here to see, okay, you know what? This is a short-term uptrend. As long as it stays above here, it's valid and we can stay in that position, whether we entered here or here. But once it breaks that uptrend line, hey, you know what? This might be reversing. This might be consolidating. That's our telltale sign, just using market structure. And then you can see here, I've actually identified another series of these highs are descending. They're getting lower. So I've connected another trend line on top, and we basically have that same formation. It's a falling wedge. So looking long from the bottom, short from the top until it breaks out. And remember, in the falling wedge scenario, I really try not to short from the top because I never know when it's going to break out. In a downtrend parallel channel or an uptrend parallel channel, you're going to want to short sell a rally, long from the bottom, which is counter trend trading if you got the balls for it. But here in a falling wedge type structure, I'm not really trying to take shorts from the top. I'm trying to take longs from the bottom and try and catch that breakout. So this is a very interesting point of price, or a very interesting formation that I wanted to show you, because while we need to keep in mind the rules of downtrends and uptrends, I want to show you how trading a pattern can give you a little bit of different insight and a different incentive, or a different idea, a different plan in how you can capture profits. So we've taken a look at now uptrend channels. I didn't show you a downtrend channel, but I wanted to show you this falling wedge. And it's going to be the same if it were a rising wedge, right? If we were having, let me get this out of the way for a second. If we had a rising wedge and it was like this, you know, something like this, whatever, right? Price is going to be trading in here. Let me just go ahead and set this up for us how I just taught us. So we'll clone that, find our range that we're comfortable entering on the inside, clone this, find our range that we're comfortable entering on the inside, whatever that may be, you know, based off the market structure that's available to us, what kind of wicks we're seeing, things like that. Like right here, why did I choose this dotted line? Why is this my range? Well, because there's a couple touches here. So I know on the high end, I could get in on those touches, and on the low end, that's where the wicks are going to dip to. Same thing for here. I chose this as my spot because there's a little bit of a high end here, and the wick range is a little bit in the zone. If I were to bring this down to these, I just wasn't comfortable with that range of entry. It was a little bit too large for me. So I tightened it up, and that's where I would be comfortable either taking profits or entering shorts. But remember, we just talked about the falling wedge, how I don't like to take shorts from there. But anyway, if we're seeing a rising wedge, it's the opposite of a falling wedge. Remember, we were trading the parallel channel. We were longing from the bottom, taking shorts from the top. Okay, so if price is in a rising wedge, it has a higher likelihood of breaking down, right? If price is in a falling wedge, it has a higher likelihood of breaking up. If price is in a rising wedge, it has a higher likelihood of breaking down. So this is where you're going to be able to more confidently counter trend trade, because we know that when the breakout occurs, or generally speaking, when the breakout occurs, it breaks towards the bottom. Now, price could defy that. Price could always do whatever the hell it wants. It could break above and just continue a parabolic state. I've seen it before. I've seen it before. I'll see it again. Okay, so we just need to be careful of that. So that's kind of how, these formations can differ, and that's how you can take advantage of them. That's how you can identify them and draw them. So let's see if we have any other questions, and then I want to actually get you guys set up with, I don't have any way to check your homework, but I want to tell you guys to go get into your trading and start looking for some of this shit, or into your trading view charts and start looking for this shit. So let's see what kind of questions you guys have. No questions. No questions. I'm seeing no questions here. Michael James says, heart. What's up, Michael James? Mikel James? Not really sure. And let me see. Pin says, can you show the current BTC parallel channel? Nia says, how to avoid false breakout. Okay, can you show the current BTC parallel channel and how to avoid false breakout? So we'll go with, Niaz is one of my supporters. Pin, I'll get to your question in just a moment, I promise. But Niaz is one of my supporters, so I'm just going to show real quick how to avoid a false breakout. And in this particular instance, I'm going to go to Bitcoin, because we just had one of these not too long ago. Let me see. Where was that damn trend line at? I had one of these here. Okay. Now I got too much shit going on. Let me close some of this out. I found what I wanted to show you. Okay, close that one, get rid of this, close that. Okay, so here, this on the 4-hour time frame, here we have a wick, right, Niaz? On the 4-hour time frame, it comes up, but it shoots back in. So on a smaller time frame, we will be able to see, let's just go over to that if I can find it on the 1 minute. Hold on. Let me circle it so I know where it is I'm looking for. All right, so I'll circle it here, and let's just go into the 5 minutes so I don't get so lost. Let me see if I can find that circle. Okay, oops. Okay, right here, we're going to need to use multiple time frame analysis, and even on a smaller time frame, even on a 5-minute time frame, we see price popped up, the very next candle drove it back in. So if we could see price pop up and another candle close above, another candle or two would be more acceptable. Like remember here on the 4H, there were on smaller time frames we had many candles can close above this. On the 4H we had a candle close above right there and then pushed up. So in this particular instance we had a candle push up, but it immediately re-entered. Immediately it re-entered. Now if we go look at a different point, I'll show right here since I got both of these set up now. So right here we had another downtrend. I was using this as a projection. This was a third touch. So here we see a huge blowout candle. It's going pumping, and then we have these two here, right? So you have to use multiple time frame analysis. Here we see this big blowout candle. We're like, oh man, this could be it. This could be the one. This could be, it could be pumping up from here. So the best way to make sure that you don't get caught in a fake out whenever that occurs is to go into a smaller time frame and find where your market structure is trending. So if we see here, okay, it's broken out above that line. This was the line where the breakout was, and this was that big old 4H candle. So we can see here a little bit of different market structure. We didn't talk about this type of market structure today, but we can see here it comes up and it's creating a bear flag. So we see it breaking out. We don't just want to shoot in on something that's pumping so crazily like that, because we don't know at what point if it's going to reverse. There's not a lot of indications right here whenever we're looking at it exactly at this moment in time, right? We don't know what's going to occur. But as we wait just a little bit, we see prices starting to falter. It's got to have some type of pullback if it's going to continue an upward descent. And now we're witnessing, if I can just back it up a little bit. Oops. Oh man, it's taking me over here. Okay, so we're right here. Oh, sorry, this is where we were. Okay, so we're right here. What we are looking at now is a bear flag. I'm sorry, a bull flag. Price is coming up. Remember that bear flag I showed you earlier? Here we have a bull flag. So price is coming up. We know that when we see bull flags, the likelihood of it breaking up is higher than the likelihood of it breaking down. It definitely could break down, but the likelihood of it breaking up is much higher. And so whenever we see a bull flag, we can say, hey, you know what? I'm going to set up my long in here inside of this, because this is actually considered a consolidation. Price is not forming higher highs. Price is not forming lower lows. A wedge is a consolidation. It doesn't have to be between two horizontal points like I showed you earlier. That's the easiest consolidation to spot. But this wedge, any wedge, is a consolidation, right? Unless it's a falling wedge where we have those, both of them are sloping down, or if it's a rising wedge, both of them are sloping up. When we have 2 points, one sloping down and one sloping up, and those lines meet, that's a consolidation, which is commonly referred to as a wedge. And whenever we see this wedge structure here in a bull flag, we can say, hey, you know what? I'm going to take this long here. I'll put just below that swing low. We don't want to put it right below that trend line because we have that swing low here in the bull flag. And then we target back to the top of the bull flag. Once it starts to be profitable, remember how I was saying earlier, Niaz, we want to move our stop loss with the trade. So we see that price is starting to break above here, and we're like, oh, fuck, it's gone through here. I'm just going to go ahead and move my stop loss up now to the recent swing high, right? So if price comes back below here, I'm not going to get stopped out for a loss. I'm going to get stopped out for a profit. And as price continues its ascent, we just keep moving that stop loss to the new market high. And whenever price breaks back below, boom, we get stopped out for a profit, and we don't have to fall victim to the fake out. Because look, now it's going to go all the way back down. Well, it looks like it's going to be some time before it goes back down. But here, we don't have any market structure telling us, yo, right here, we've already hit our stop loss. The trade was successful. Now we just need to wait and cool off a bit. We can reanalyze and say, hey, you know what? There is like a little uptrend here. And these are creating higher highs. But price seems to be running into some resistance from here. Here's the resistance point. So we'll just carry this out. If it breaks above, we can consider this another flag and try and go after it again. Moving our stop loss up all the while. But here we see it's actually breaking down over that uptrend line and starts to come back down. So all of this occurred within a few 4-hour candlesticks. Let me just come over to the 4H here, and we can see what that looked like on the 4H. Yeah, so here it is right here. And when you're looking at the 4-hour candlesticks, there's not really much information that would tell you, hey, dude, you could go for this. You could shoot this. You can get in on this, right? But when you look into a smaller time frame, you can see the market structure we've talked about, which I referred to earlier as macro structure or micro structure, whatever part of the world you're from, both means the same thing. Macro and micro both mean the same thing. So we've identified that macro structure now. We looked at the bigger picture. We saw that it was a potential breakout, and we looked, hey, it's breaking up. I want to go long. How can I get in on this long? So I'm going in at that rate right there. And remember, we're constantly adjusting our stop loss to the previous market high, chasing it up as high as it will go. And eventually, when it hits our stop loss, that's it. We're out. We're squeezing the price as much as we can, chasing that movement upwards. So that's how you can avoid a false breakout, right? Another way, if you don't want to be aggressive, because this is an aggressive approach. This is an extremely aggressive approach using multiple time frame analysis and jumping into something like this when it is breaking out. Like I said, you usually want to identify that the trend is a valid trend before you get into it. But another approach is actually waiting for that retest. So if we get a retest at this level, that would be a perfect time to enter. So there's two ways. Waiting for a retest, but in some scenarios, especially this one, you wouldn't have got a retest. You would have got no trade. If you were a little bit more aggressive with the market structure available, you could have said, hey, you know what? If it breaks below here, I'm going to get out. It's probably a fake out. And still tried to chase it up, as I just demonstrated in this particular example. So Niaz, let me know if that helps. Hey, Pin! What's up, Pin? We got a new supporter. Shout out fucking Pin. My man. Thanks, Pin, brother. That means a fucking lot, bro. Oh, man. Oh, Pin. Is it because I said I would get your question second after Niaz? Well, Pin's a supporter now, so let's get to that question. Niaz, let me know if that's good for you. T-Cal, I see you left a comment there just recently. Let me go ahead and let me answer Pin's question now because he's one of our supporters, and I did tell him that I would get to his question after Niaz. So he says, can you show the current BTC parallel channel? So I'm not sure exactly what you mean by current BTC parallel channel, but right here, it's actually not much of a channel. We have a downtrend, and if I were to clone this, I'll see how much of a channel it could be. So I've cloned it, brought it down. It doesn't always fall to the bottom here. You see, if it were to follow this channel, it would end up being a negative asset. So, to some degree, the channels aren't always going to be perfect. This, you could call this a parallel channel, but realistically, you would have to connect probably some different lows to see maybe here. That would be like a falling wedge, or here, trying to maybe cut through 1 or 2 wicks. But there is not really an active parallel channel on BTC right now. I'm not going to try and force it. Sometimes when you have projections based off of 2 touches, the third touch comes down, comes out. It doesn't mean you cut through the wick. If the price information is already there, I try not to cut through wicks if it's not necessary. Okay? And here where we are, the current, I would say, if you're asking about a parallel channel, our current price channel is trading between these 2 ranges. Price is failing to break above this high. Price is failing to break above this high. And if I look at I don't know where my recent structure is right now. So let me just turn on active structure. I'll turn it all on there. And damn, is it in Trade Scratch? Is it in Group 1? Okay, cool. So I've got a couple different ranges here on Group 1. We can see this doesn't constitute a parallel channel, but here's another area where I'm looking for resistance based upon that zone right there, these wicks and these wicks, another zone right here. So as it breaks into each area, we say, hey, it breaks this horizontal support, right? Now we know it could trade in this one. If it breaks above here, it could trade between these 2. If it breaks above here, it could trade between these 2. So when we have this type of information, we're trading between these horizontal ranges, and that's an uptrend. Okay, so we have a dynamic support range. If price meets here and it says, hey, you know what, price is coming here, and it touches this horizontal support zone and this dynamic trend line, that's probably a good entry. We have 2 confirmations there that there is possibly a support, and we could set up a long to go inside of that. But to answer your question about the current parallel channel, there really isn't one available right now. You're just going to have to, you can't always find one. You can't always force one. It has to be there. But this is the current, the closest resistance and support zones in the immediate price action, Mr. Penn. All right, so let me see where we are now. Alex Me says, awesome trend line explanation. Fucking great, Alex. I'm glad you learned something. I'm glad you think it's awesome. And let me see. T-Cal now says, yo, bro, how to know which works to exclude and draw a line over them? Oh, how to know which wicks to exclude and draw a line over them, especially in a messy chart. Okay, so that is a very good question. Let me just go ahead and put up my group 2 again. So he says, which wicks to exclude and draw a line over them? So in this particular example, let me close out these rectangles. In this particular example, I base this trend line off of a projection. I always do that. Anytime I have 2 points, like right here, for example, I always do this. If I have 2 points here, I'll make that trend line. If I get the third touch here, I know it's good, right? And then we're just going to go ahead. Hey, look, we're looking for a third touch. It gets the third touch. Maybe we push off of that. So here, in this instance, I had drawn this downtrend line based off of these 2. And you can see I have another one here, right? So I have a little interim trend line because I'm using these wicks. And I have another one here because this is what I was using at first. But as price developed, it made another high, so I gave it another trend line. And then ultimately, when price pushed through there, we saw that wick get rejected. So I didn't intentionally cut through this wick. I already had that trend line drawn. So I would advise you try not to cut through wicks as often as possible, but it is sometimes okay. Like we can see this here is a very huge wick. And in a lot of altcoins, you're going to see that. Oh my God, you're going to see that so much where those wicks are just fucking all over the place. And sometimes you have to exclude them. When you are excluding wicks, I would try to say to use candlestick closes, right? Because here we see, it's based off the wicks at first. It touches through those candlestick close. Here's candlestick open and close. Whenever you have to, I would really you rather not cut through wicks. But whenever you have to, you should try to find an open or close price to put that trend line along. And one way that you can actually draw these lines a little bit better, it's not going to be 100% accurate because, let me show you why. You can change to the line graph and it'll make it a little bit easier for you because there are no wicks. And you can see where there are active and valid trend lines. But you see here how it's not, see how that line's not touching there? And if I put the candles, it's touching the wicks. But if I come back to the line, it's not touching the wicks. So I can see here, you know, if I move this up, that it dips down below, and we can make something of that. But the reason it looks like this is because this is using open and close prices. It's not using wicks. It does not account for wicks. So you can use the line graph to just, maybe when you're getting started, I wouldn't depend on it forever because it does not always show true value and true range. That's why I like to use candlesticks. But that's a little helpful tip for whenever you're just getting started. Don't fall in love with the line chart because it does exclude some data. All right, so where do we leave off at? Pin. Thanks again, man, for becoming a supporter. Shout out, Pin. Nia says, thanks a lot. Payaso says, lol. He's drowning. Look, lol is a little guy drowning. Do you see that? The circle is the head and the hands. He's up like this. He's like, help, I'm drowning. I've always thought that. It's always a person drowning to me. Pin says, thanks, DC. Yeah, I meant the horizontal one. Awesome. Yeah, that's our current range right there, brother, for the horizontal support and resistance. We don't have any active dynamic parallel channels. And Tikal says, so do we adjust a line after it's wicked? Okay, Tikal, that's a great question. I would say not entirely, as we could see here. Let me just go ahead and put that into perspective for us. So I'll put that there. Our dotted line was the first one. Our dotted line is the first one. Dash line was the second one off of this wick. And then this solid line is going to be off that wick. And we'll just go ahead and watch this. Right? So we go, boom. Here's our first reaction. Pump through. Didn't do shit at that reaction. But look here. Look at that. Price is getting a rejection here. And it's playing along this line. So I have charts that look like fucking spaghetti. Let me see. Oh, not my Bitstamp chart. I gotta go to my Binance chart. Okay, so yeah. I have charts that look like spaghetti. Now, whenever you're making these projections, to some degree, they will be touched, they will be respected. But you don't want your line, I'm not going to say you don't want your chart to look like this. If you draw these lines, you understand where the reactions could be and what it's trying to tell you. I would like for you to try to keep your chart as clean as possible. But, you know, even as we just saw here, when we were drawing these lines, let me go ahead and get out of the replay. When we're drawing these lines, they can take effect to some degree. So if you want to if you want to adjust for the new wick, I would say leave your old trend line there because it may have some validity. As we saw here, there was a rejection before that big burst. Okay? So if you see a wick that pops over, for example, this wick popped over and above, try to draw a new line because it may have some respect in the future. Okay? I hope that makes sense for you, Mr. Tikal. And then Payaso says, cat in the box. All right, guys. All right. So that is going to conclude my presentation for our drawing valid trend lines. If you have any questions, we've been answering them. If you just joined the stream late, you can backtrack to rewatch the presentation. But if you have any questions now, guys, anyone who's been here with us for the stream and got to see the presentation, excuse me, now is a good time to try and ask any questions if you have them. Loud and clear, bro. Thank you very much. Yes, sir, Mr. Tikal. I hope my brother 420 Ninja was in here. We were talking on Discord just a while ago before the stream, so I hope you made it here. I don't see you. Well, maybe just because you didn't leave a comment. I don't see anyone in the stream. But anyway, if you're here, 420 Ninja, say what's up. But if you're not here, that's all right. Hopefully you can see the replay. And to anyone who is still here with us, I really appreciate you guys coming out. Without you guys, I'd just be talking to fucking ghosts or, you know, my PC, my camera, my wall. I really appreciate you guys. Without y'all, I'd just be lonely trading. You know, there's not really a lot wrong with lonely trading, but definitely love to have friends. Definitely love to help other people out. One of the biggest reasons that I started doing this was because in my real life, when my life started to change for the better, whenever I was first getting good at crypto trading. Like all my real life friends, I tried to convince them. Some of them took interest, and I made like a little guidebook, and then I started to like, you know what, I'm gonna make these videos. Ultimately, there are some of my friends in real life who are here trading with me now. But ultimately, most of my friends in real life didn't have an interest. They're just like, yo, you know what? I remember specifically having a conversation with one of my buddies, and I was telling him, bro, like, you know, you can learn this, you can do crypto trading, you can make money from anywhere, bro. You can do this. And what he told me was, said, bro, I don't like crypto. I'm not into crypto. I don't want to do crypto. And he still to this day has a regular manual labor job where he's working for somebody else, getting paid by the hour. And I don't understand why people, it's like, bro, do you think I like doing this shit all day long? You think I like staring at charts and doing this? No. But do I want to go out and work for somebody else? Do I want to have to leave my house every day, waste money on gas, risk my life on the streets, driving somewhere where hundreds of thousands of people die every day on the road in car accidents? Drunk drivers, stoned drivers out there. Like, there are so many better options than working for somebody else. One of the options that I would recommend is to day trade crypto. But my friends in real life just wouldn't fucking get on board. Some of them wouldn't get on board. So I was like, you know what? I can't waste all my energy trying to help someone who doesn't want to be helped. Let me go out and see who I can fucking help. So you guys that are here, thank you for letting me help you. Thank you for giving my life some type of purpose and just letting me do my thing. I really appreciate it. So if we don't have any other questions, guys, I know T-Cal, it's fucking sad. It's sad, you know, and ultimately we can't waste our energy on people who don't want to be helped. We have to put our energy in ourselves and the people who are willing to learn. So guys, if there are any last minute questions or comments, I'll be more than happy to answer them. But if we don't have any more questions, we can go ahead and call this one a wrap. I'll give it a few more minutes. I don't have any vitamin water here to say shout out vitamin water, but shout out vitamin water. Hopefully one day we get a sponsorship from them. They probably still don't know I exist, but whatever. I drink vitamin water. It's fucking good. Let's go vitamin water. Shout out vitamin water. Glaciu. T-Cal says 9 to 5 is trading time for safety, which always screws you. Yeah, absolutely, dude. I mean, I know, man. That's exactly right. Whenever people get too comfortable with that, they're like, "Yo, learning trading is scary. Learning trading is hard. Learning trading is something I don't want to do." It's like, bro, I don't want to trade crypto. I want to be wealthy. I want to have streams of income, and I want to be able to live the life that I feel I truly deserve. I want to be able to take care of my loved ones. I want to give my future children the best opportunities possible. I want to be able to get them through. I'm not going to force them to go to college, but I want to be able to pay for their schooling. If I get sued, I want to be able to pay for a lawyer. If my kids or my wife gets sick, one of us gets cancer, I want to be able to pay for the hospital bills. Like, yeah, I understand. Money is not, money can't buy happiness, but it can buy you a lawyer, it can save your mother's life, your daughter's life. Money is important. And I'm not trading crypto because I like trading crypto. I'm trading crypto because it's the easiest way for me that I've realized to multiply my money with the minimal effort. Like, what am I doing? Sitting here at a computer and clicking buttons all day. That's the bare fucking minimum. Yeah, it can be mentally daunting sometimes, but it's the bare fucking minimum. And it's another aspect of it is there's no guaranteed income. Like, homeboy goes to work, he knows he's gonna get a check every Friday, every other Friday, whenever he gets paid. He knows he's gonna get that check. Now, it's gonna be the same amount of money. He might get a raise, but he knows that money's gonna be coming in. The danger or risk in crypto trading is that there is no steady income. The income is dependent upon you taking action. And that is scary for a lot of people who fail to take action, who are unmotivated and undisciplined. So, there are a lot of different things that have to tie in with trading. You can't just know how to draw valid trend lines and be like, yep, I'm a pro trader now. I'm going to get fucking rich. There's a lot of different aspects you have to manage. And I understand it can seem scary to people whenever they're brand new. But man, this Bitcoin, trading crypto changed my life for the better. I know it's only going uphill from here. And thank you guys for being here because I know as long as you stay true to this path, stay true to yourself, you stay disciplined, you keep showing up, right? You don't you don't have to be motivated. You just have to keep fucking showing up. Just keep showing up, keep showing up, keep putting in the work, keep learning, and one day it's gonna work out for you. All right. TCal says I'm gonna call my broker and ask him to invest my 100K for 1% a year. Yeah, no, fuck that. The best investment firms only getting 4 to 11% sometimes a year. I can get that shit on the toilet. My boy Ricky Spanish made 25% this morning in like 5 minutes. I don't know if he was on the toilet or not, but fuck. I mean, come on, man. All right, fellas. Well, thank you all for coming again. I really appreciate it. I hope this lesson was valuable for you. I don't have any other live streams scheduled right now, but I will get some scheduled very soon, guys. I promise you. More than likely, the next one's going to be next Friday around the same time. So, once again, thank you all for coming. Shout out my supporters, Niaz, Tikal for being already existing supporters, and Pin for becoming a supporter during the stream. Y'all are the fucking truth. So thank you, fellas, and I will see you next time. Toodaloos, everybody. I'm going to sit here and try to smile away until the stream ends because I never really know when it ends. Bye, everyone. Have a beautiful time. Do, 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 ba, ba, do, 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 da, toodaloo.